Good afternoon. I'm Thorsten Beck. I'm the director of the Florence School of Banking and Finance, and I would very much like to welcome you to this Executive Seminar 2021. Traditionally, the Executive Seminar is being held together with the Advisory Council in July, like this year, and it's a multi-day event with a number of speakers, a number of policy discussions. Of course, given the current times, we cannot easily replicate this online. So we decided to have a shorter session of the executive seminar with two in this case, main speakers, and with a very exciting topic, which I will turn to in a moment. Now, before I come to this, maybe let me just, for those of you who don't know yet, the Florence School of Banking and Finance, located at the European University Institute, we have an exciting program of different training activities in all things banking and finance, from more methodological to more practical courses. And we just released our fall program. 5 of the 6 courses are online. Actually, we are hoping very much to have 1 residential course. And then, of course, hopefully in 2022, we can go back to a stronger mix of residential and online activities. But as you can see here, empirical methods in sustainable finance, macro potential, tools and policies, cross-border securitization. So there's a wide variety of different activities, and I invite you to have a closer look at our website, fbf.eui.eu. Now, turning to our today's seminar, we have a very exciting program. Exciting especially, I would say, because again, during the current times, there's a lot of talk about short-term macroeconomic and financial implications of the pandemic, of the recovery process. So it's kind of maybe nice to kind of take a step back and focus on longer term implications. And that's why we are so grateful to have Charles and Manoj today to kind of provide us with exactly that, a longer term perspective, and also on top of it, a very provocative one. Before I introduce the 2 speakers, just a few housekeeping points. So we have, given that this is kind of joined with our advisory council meeting later this afternoon, after the 30-minute presentation, I will ask whether our advisory council member meetings want to come in and ask questions or comment. At the same time, participants can ask questions through the Q&A box, so please do it, and then I will pass on the questions to Charles and Manoj. So let me then, before I give over the floor to Charles, let me introduce our 2 speakers, and let me maybe reverse the role just for the sake of it. Manoj Pradhan is the founder of Talking Heads Macroeconomics, an independent research firm. And until recently, he was managing director at Morgan Stanley, where he led the global economics team. But he also has an economic background. He was at the faculty of the George Washington University, where he also got his PhD. Charles Goodhart, to read out the bio of Charles is a bit too long, so I have to kind of pick and see what I mention. He's currently emeritus professor, but before that, he was the Norman Sosno Chair of Banking and Finance at the LSE, where he also founded the Financial Market Group, which of course very well known. And before that, he was for many years monetary economist, at the end chief advisor at the Bank of England, but he also has, of course, lots of international experience, including in Hong Kong. And of course, the one thing that not enough people, I think, actually know, and not enough people take into account, is this famous Goodhart's laws. There are many ways to frame it. I like to frame it as, if you have a policy, if you have an index, an indicator that is being used as a policy target, then it's not a good index anymore. It's not a good gauge anymore for progress. I mean, among many areas, for those of you who are familiar with the doing business controversy and scandal, I think that's an excellent example for this, for Goodhart's law. So, but now let me be quiet and let me turn over. I think Charles will start. And again, the topic is on demography, inequality, inflation. So again, something much more forward-looking that we are typically focused on. Charles, over to you. And thank you again for joining us.
Thorsten, thank you very much. It's a great pleasure to be here. I would just re-emphasize that the great bulk of our book, in fact, everything except for the epilogue, was written before the COVID crisis pandemic came into sight. And the epilogue was written very hurriedly, just as in March 2020, just as the COVID crisis started to strike. And as this first slide shows, it's about the effect of changing demography will have, and some reversal of globalization will have on inflation. I'd like to start by reminding all of you how unusual the last 70 or so years from 1950 to up till now have been. From the time when the Bank of England started in 1696 until about 1950, some 2.5 centuries or so, the long-term interest rate in the UK had remained really very, very stable at about 4.5, 4.25, 3.75 to 4.5%. As many of you know, if you read Victorian novels, holding very long-term undated gilts, consols, was regarded as absolutely safe. And that effectively means that expectations of short-term rates themselves, and inflation were all pretty stable for something like about 2.5 centuries. If you look very carefully, you can see the effect of wars driving up short rates quite a lot and long rates a little bit less, driving up inflation. Napoleonic Wars from 1797 to 1815, World War I, and so on. But nothing like we've had in the last 70 years, where we had an absolute surge in inflation, inflationary expectations, short-term rates, interest rate expectations, up to a peak at about 1979, 80, and then collapsing thereafter. Now, why did they all rise so fast? Well, it was partly that we shifted from a gold standard and an expectation that fiscal policy outside of wartime would be have a relatively balanced outcome with neither large deficits nor large surpluses, to a world in which we felt able to control demand, and we preferred to control demand over maintaining fixed exchange rates. Moreover, those in power in the 1950s, 60s, and 70s had grown up when they were young during the Great Depression, and for them, the greatest evil was unemployment. So they tended to try and fix demand at a level above the natural equilibrium rate of unemployment, and they tried to hold down the resulting inflationary pressure by prices and incomes policies that didn't work. Well, it all turned around in 1980, 79 through to 80, 81, 82, with Volcker's policies that he introduced in the US very bravely. And from then onwards, inflation, inflationary expectations, short-term interest rates, and so on tended to collapse. Now, a lot of that was due to better monetary policy, central bank independence, and inflationary targets. But it wasn't only that, because as you can see, with the very few exceptions, it was a steady downwards trend. And that downwards trend must have been due to some other disinflationary forces. And indeed, ever since the great financial crisis in 2008, 2009, despite central banks trying to throw everything they had, the kitchen sink, at trying to raise inflation back to target, they were unable to do it. So what was it that was in the background bringing about massive disinflation over the course of the last 3 decades or so, from 1990 on to about 2000, well, until really after 2010. Now, the answer, we think, is a combination of demography and globalization. You look at the left-hand chart, what you will see is that the blue line represents the working age population in the advanced economies. And you can see that was growing slowly. But rather more slowly than the yellow line, which is the working age population in China together with Eastern Europe, which were the groups of countries that joined the world's trading system after about 1990, when Chairman Deng took over from the disastrous policies of Chairman Mao Zedong. And of course, China is the most populous country in the world, and it was growing, the working age population was growing very fast. So for any employer who could shift their place of production, whether of goods or services, from the advanced economies where wages were high to the low wage economies in Eastern Europe and China, it represented a marvelous chance to cheapen the cost of production and export the production back to the advanced economies, which was done dramatically with the share of world exports from China, for example, rising from about under 3% of the world's exports to increasing by about 8 or 9 times over not more than about 20 years. Now, again, what you can see is the working age population from now on will trend downwards, with the great exception of the dashed line about Africa. And we may want to talk about the potential role of the massively increasing working age population in Africa, in parts of India, and maybe in parts of Latin America later. The right-hand chart simply shows the sort of annual changes in the working age population. Now, it was not only the working age population, but at the time when I was young, sort of in the end of the 40s and the 50s, half of those of the working age population, that is the women, very rarely became became actually workers, because they were at home doing housework, looking after the children, and that was socially desirable in many ways and added to welfare, but did not add to GDP, to the domestic production. And what has happened ever since the 1950s, as a result of a combination of the dramatically falling birth rates, now in many of our countries, to significantly below the sustainable rate, combined with the advent and the availability of consumer durables, washing machines, refrigerators, and so on, has enabled an increasing proportion of women to become workers, to join the workforce. So the demographic effect of the combination of the growth of the working age population, the availability of women within it, and this availability of workers in China and Eastern Europe led to an increase in the available supply of workers over the last 30 years or so to more than double within that period. And there's never been anything like it. The only near equivalent was where the Black Death affected Europe and halved the working force very quickly. This was a massive positive supply shock. Never ever has there been such an increase in the available workforce facing employers. And the result of that and the availability of shifting the production from the high wage economies in the West to the low wage economies, particularly in China, have been dramatic. This table from our book, in many ways, I think, is the most dramatic set of figures in that whole book. And that shows the ratio of workers' wages on the left-hand side in the USA to that in China. In the year 2000, the ratio was 35-1. An American worker had 35 times the wage of a Chinese. By the time you get to 2018, remember we wrote this book primarily in 2019, it was 5-1. Now that means that the ratio changed by a factor of 7 times within less than 20 years. It was somewhat the same in Europe. with the shift from Western Europe to Eastern Europe, and the ratio of France to Polish worker started from about 4 to 1 and was down to about 3 to 1 at the end of the period. What this meant, remembering that China is the most populous country in the world by quite a long way, was that world inequality actually reduced pretty sharply. As Mihailovich has shown, starting from about 2010 or slightly earlier than that onwards. World inequality had been growing ever since 1700, because actually where you were in the income distribution in the world depended not so much on who your parents were, but where you were born. If you were born in Europe or in North America, you were almost by definition in the top 20 to 25% of income distribution, irrespective of who your parents were. And if you were born in the rest of Asia, Africa, and so on, you were in the bottom 50 or so percent. Of course, this meant that the shift of production, particularly of good manufactured goods, of course, meant that the wages of the blue-collar workers, particularly in the US, but also in Europe, declined relatively to the wages in the low-wage economies. And of course, it was a wonderful time for anyone who had access to capital, whether human capital, financial capital, physical capital, or whatever. And the last 30 years have been dramatically good for the holders of capital, and really relatively poor for those whose only ability was to provide labor power, muscle power in the production process in the advanced economies. So within country, inequality increased quite dramatically, and that led fairly naturally to the growth of populism, because although the workers had their bargaining power trashed in economic terms, they were still able to vote, and they didn't like what they saw with the increase in inequality and so on in their own countries. And they blamed largely immigration from the low-wage economies, and they blamed globalization, and they blamed the elite not having the interests at heart. I would just add for this particular audience that I think that this globalization in particular had an extremely adverse effect within Europe on Italy, because the goods in which Italy had a comparative advantage, clothing, fashion goods, etc., were exactly those which the Chinese were able to compare and make much cheaper, whereas Germany had a relative easy run because they produced the capital goods and the motor cars that the Chinese wanted. So that the relative shifts between Italy and Germany have in turn been due to this globalization effect. But what we now have, of course, is a major shift in demography, with the reduction in the number of young, with the fall in the birth rate very marked, together with the massive increase with the expectation of life increasing and retirement age until very recently in many countries actually going down. So the period of pensions has increased fairly dramatically, and the average age of death going up. And one of the problems here is that medicine has done wonders in curing the kinds of diseases that could strike relatively early, cardiovascular and cancer. What medicine has completely failed to do so far is to deal with the neurodegenerative diseases that overwhelmingly affect the old, and affect the old increasingly the older they get. These are dementia of various kinds, Parkinson's diseases, and what have you. Now, what this particular diagram shows is that it is not true that consumption is equated over one's lifetime. The young don't consume all that much, but the old in the advanced economies do consume a lot. It's not, since I'm one of the old now, it's not that we buy more clothes, it's not that we eat more, we go on more holidays on the whole. But the reason why our consumption goes up is actually because there is more need for care, for health care, for care with the activities of normal daily living. When you get dementia or Parkinson's, you need help to continue in life. Um, and we have to have that, and it is extremely expensive. And an increasing proportion of the workforce is going to have to be shifted over to looking after us old people. We old people are expensive. And indeed, there is a feeling that at the moment in the UK, if you get cancer or heart trouble, the state looks after you and pays for your costs. If you get dementia, the state on the whole does not. You are required to pay yourself for your costs of your care home. And there's a feeling that even that should pass on to the state, which would put yet another burden on the expenses that the state will have to bear to pay for the pensions, the care, and the medicines of the old, which is going to lead, under present policies, to continuing deficits. And COVID plays a relatively small part in that. Now, comes from the Congressional Budget Office, and this is their projection until 2050 in July last year after COVID struck. But the rate of change of the debt is actually unchanged from what it was before COVID struck. You can see the effect of the COVID pandemic with that little blip currently, but the little blip is really fairly temporary. What is the problem is not the COVID pandemic, it's the underlying demographic structural forces in our economies. I would also add that the debt ratios that are now facing many of our economies are not higher than we've had in the past. You can see in this US case, it's currently about the same as they faced after World War II. But there are important differences. The debt ratios shot up during wars, but wars, thank God, are temporary, and absent even worse epidemics or nuclear war or something, the demographic structural change and the cost of the elderly is not temporary, it will continue. And it is projected to continue. Whereas after wars, the general expectation was that public expenditures would get cut back because most of them were in wartime expenditures, and we would cut back to balanced budgets or even primary surpluses, and that the debt ratios would go down. That's not the case now in the projection. So where are we going? What's the end game from here? And I can't emphasize too much. This sort of concern about the longer term future is not COVID related. It will not go away when COVID is gone. Now, the best way of dealing with debt, whether in the public sector or the private sector, is through faster growth. But the problem here is that faster growth is extremely unlikely because such growth is a function of the rate of growth of the number of those who are in the workforce or actually workers interacting with the increase in productivity that they can bring to bear. Now, the point again is that demography and the fact that the birth rate has been falling for quite a long time, has been low for quite a long time, below the sustainable rate, means that the rate of growth of the working age population is going to fall, and through much of Europe, including Italy, and including most of continental Europe, the number of available workers is actually going to go down. That is of itself going to reduce aggregate gain to growth. There will be an offset because we think that productivity will rise because as the available workforce declines, and also as globalization goes into reverse with a US-China spat, the effect of the coronavirus pandemic, making most countries feel that they have to have many crucial industries at home, and the rise of protectionism, that this is going to mean that investment, much of which went into China and Eastern Europe, will now come home. And in order to deal with the rising unit labor costs brought about by tightening labor markets, I think that investment ratios are going to rise. Indeed, they are currently rising, and that will lead to greater productivity in those countries such as Italy and the UK, where productivity has been very disappointing in recent years. So we think the productivity will rise, but relatively modestly. Now, that said, it's going to mean that if we're going to get away from continuing, indeed even worsening primary deficits, we've either got to cut the benefits to the old, raise the age of retirement, make the old pay for their care, provide less in the way of Medicare and so on, none of which I think are highly desirable, or we're going to have to raise taxation. And I think that an increase in taxation is in a way the right solution, but politically it's extraordinarily difficult. And I think most economists believe that a carbon tax is desirable, but when Macron tried to introduce something along those lines in France, you got the Gilets jaunes. And you name whatever tax increase you want to introduce, I can tell you why it will be politically difficult to do it. Now, if we're going to have rising debt ratios and still primary deficits, it's going to be extremely difficult for monetary policy by itself to bring about stable inflation, bring it back to target. Because the increase in interest rates that will be necessary to do that, first of all, they too are politically unpopular, unattractive, with mortgage rates going up. Secondly, we've already got financial prices, asset prices so high that any increase in interest rates is likely to bring about sharp declines in asset prices, even perhaps recessions as a result, which would do nobody any good at all. It's going to be extremely difficult, unless you get the fiscal policy right, to put all the pressure for restraining inflation onto monetary policy. With the result that the one mechanism that reduces debt ratios without having to take unpopular active policies, whether fiscal or monetary, is through increasing inflation. And we think that however unattractive inflation may be, it will be the political optimum because it doesn't involve having to undertake politically extremely unattractive steps. In our book, of course, we can't deal with everything, and we didn't deal with the environment, climate change, and all the rest of it. And one of the things that, again, I would say is that climate change is likely, at any rate within the next few decades, to be also lead to increased demand, to reductions in certain kinds of capacity, to higher energy prices and so on, and will in turn be inflationary. Now, we did all that, and we wrote the greater part of our book before COVID struck, before we knew about that. And one of the immediate responses, the counter arguments, is that if demography and an ending to globalization is going to be so difficult, why didn't it happen in Japan, where a much higher proportion of the population became old earlier than the rest of the world? And also there is the wider question of how will the pandemic, which occurred effectively after we'd written the bulk of our book, impact on our thesis. And I'm now going to turn over to Manoj to discuss the short-term issues that have arisen as a result of the COVID pandemic and deal with some of the counter-arguments and one or two other measures as well. So over to you, Manoj.
Thank you very much, Charles. Thanks, Thorsten, and thanks to FBF for having us here. I'll try and keep some of my remarks a little bit more brief, and we can come back to them in the interest of time. I'm going to argue 3 points here, one about China, one about where our star is going to go, and then about Japan. My first 2 points are trying to marry the broad thesis that we have about demography to the events that we are likely to go through over the next few quarters, months, and years. So back in 2014, I think, if I'm not mistaken, then Bullard, who was an FOMC member, was on one of the radio channels, and he had a rather nice way of saying that if you look at a murder mystery setup, who killed the Phillips curve, it's the Federal Reserve that killed the Phillips curve. I think he may be more innocent than he thinks. We think that perhaps the Fed could be brought up on charges of assault and battery, but murder has not yet been proven. In fact, the Phillips curve is dead and alive. It is in a coma, but it's China that has put the Phillips curve in a coma. So let me just walk you through a basic argument. On the left-hand side, you see a slide that comes from the St. Louis Fed. Hooper et al. Had this moving coefficients estimation of the Phillips curve. And what you see is that from the mid-90s, the Phillips curve gets flatter and flatter. The relationship between the unemployment rate and goods price inflation becomes less and less interesting. And in fact, in the 2000s, it reaches a point where the Federal Reserve then looks at it and says, well, does it have any real forecasting power? There may be a link, but can we use it as a forecasting mechanism? And in the 2019 review, it says no. However, this is, as we know, estimating the Phillips curve is a reduced form exercise. The structural equations don't really go deep enough to find out why inflation has fallen. And if you look on the right-hand side, this is a chart that comes from Andy Haldane's speech about a month and a half ago called Inflation Tiger by Its Tail, in which he attributes the bulk of global disinflation over the last few decades, as we do, to the very dominant role of China, its increasing footprint in the global economy. So what you have over there is that China drives inflation down, and that decline in inflation is picked up by the US Phillips curve estimate, which then suggests that the Phillips curve is not really relevant anymore. But that surely is a conditional statement on China being able to lower inflation on a permanent basis, which we don't think is possible. If China has finished its disinflationary impulse from a global point of view, then that decline on the right-hand side should be mostly over and done with. And the downward pressure on the Phillips curve that was being deployed over the last 30 or 35 years should be abating. If you look at it from a composition of growth point of view, we all know that starting in the 90s, the investment to GDP ratio in China shot up dramatically. There are many reasons for that, and we go into depth in one of the first chapters in our book. But the effect of that on the right-hand side is that the proportion of consumption in the US economy, which was already rising and coming back to its levels that we had seen in the 50s, then got a chance to rise even more. And in fact, there's an excellent paper which we quote in the book as well called The Surprisingly Swift Decline of US Manufacturing Employment, which shows that as China received most favored nation status in 2000 in the US, the goods on a micro basis that were threatened by tariffs, the lowest value added and highest human content goods shifted over to China, and that labor was released. The reason we didn't see that labor creating unemployment is because of what we call Bretton Woods 2, creating very low interest rates and pushing the housing boom forward, so that construction employment went up. So the introduction of China was not only disinflationary, but it shifted the composition of growth. And what it did was it brought the output gap back to a normal level without allowing inflation to rise. Now, today we are in a position where those stories don't generally hold. We don't have an incremental role for China, which will allow disinflation, which will allow the US consumer and the housing market to keep rising at a very rapid pace. And in fact, if you look across most economies, what we've seen is that M2 growth, this has now begun to fall. The chart probably needs a couple of months of update. The series has been discontinued, so please bear with me. But what it tells you is that currently what we have is that the monetary aggregate footprint has been dramatically higher and output gaps have been lower. So the two main models of inflation, Friedman's monetary aggregates and the Phillips curve model, are both showing you completely opposite signals. And in fact, those signals have been dampened as well. We're all at home. I think, Torsten, you're in your offices now, but Charles and I have been operating from home for a very long period of time, which means all the coffees that we are having are produced at home through manufactured goods. We're not paying for services. And a large amount of the money that gets injected into that services sector is simply not flowing there. So while we've had monetary aggregates very high, the velocity of money has come down very sharply. And even though fiscal and monetary policy has been injected aggressively, we all know that personal savings are high for the exact same reason, that we haven't gone anywhere. So our COVID income has far outstripped COVID consumption. All of that is likely to reverse in 2022 to some extent or the other, which means that the full force of both models, the Friedman and the Phillips curve model, will be pointing in the same direction in 2022. And Charles and I firmly believe that these kind of surprises that we've seen of inflation being at 5%, which really shook people, it's something that we had thought might happen a year ago, are the nature of surprises that we will see over the next 12 to 24 months. I'll keep some comments very short over here. There is a lot of misgivings about R star as well, but I think what markets get very wrong is that the way real interest rates behave in the short run and long run are very different. In the short run, we all know that the amplitude of investment is higher than the amplitude of savings. Investment tends to fall in a much sharper way, whereas consumers temporarily smooth consumption. And that means when there's a recession and investment falls, you get the demand for loanable funds falling very sharply, which brings R star down. In the long run, however, what tends to happen is that as demography changes, the slide on the upper left-hand side tells you that as societies get older, the household savings ratio tends to fall. Charles has already mentioned that life expectancy has far outstripped retirement age, which means the current households are going to have to go much further into their savings than they had done before. And at the same time, there are two parts of investment that are often misunderstood. Housing is the biggest stock of capital in the economy, and the elderly don't like to move. I know from personal experience that my dad, who is suffering from neurodegenerative diseases, unfortunately, he doesn't even like to leave his room, let alone the house. He finds it very uncomfortable and very disconcerting, which means that the current stock of housing that we've got is not fungible across generations. The old will remain where they are, and we'll have to have housing investment supported by building new houses for the young. You've seen in Italy that because of the demand for services, many smaller towns have been left empty. And that is also something that we have to take into account. Whereas, as Charles said, productivity in the corporate sector, which had been dormant for a while, why invest if you've got free labor? That is going to change. As labor becomes more scarce and more expensive, what you will see is that the demand for capital and capex and productivity rises over a period of time. So R star has a possibility. We don't have as much conviction on it, but there is a possibility that R star itself could rise, which would make the inequality equation move far more favorably in favor of labor, which is not something that is currently factored in. And so all that's left for me is to figure out, well, if the story is that compelling, why didn't it happen in Japan? I mean, after all, it is the tip of the spear. It is the first economy in which the demography has turned very, very sharply. And our argument is that Japan didn't exist in a vacuum, but the analysis of Japan often is dealt with in that manner. So I've got very cheekily here, you'll excuse me if I have a little bit of fun here. I've taken 6 charts from 6 advanced economies showing debt to GDP ratios, debt service ratios, and the interest rate. And I've left off the names of the countries. And all I'm trying to show you from here is there's not that much difference between the way Japan accumulated debt and the rest of the world accumulated debt. Japan had no border to stop the disinflation that China produced in the world, as Charles has very, very well portrayed. And so it allowed Japan to have a much higher debt to GDP ratio as the corporate sector was deleveraging. In fact, if you want to be, if you have a quick look at it, you'll know that Japan is on the upper right-hand side because that's the one in which the red axis is at 250% of GDP. But the nature of it is common across. There's Italy, Germany, the United States, and the UK are the other countries in here. It's almost identically the same. But what was unique about Japan is that Japanese corporates are often painted as institutions which were weighed down by the burden of deleveraging. And actually, we argue in the book through a lot of painstaking research, which we believe is a new contribution to the Japan story, is that actually that's not true. Japanese corporates were very dynamic. They understood this massive global labor supply shock, and they invested, they employed, and they produced heavily abroad. The overseas to domestic ratio on all three fronts rose from about 10% to 30% over a matter of a few decades. And even today, Japan's monetary experiment, when we think about Japan as having done everything that they could to raise inflation, we tend to think that money supply must have been 10, 15, 20%. What we try to show over here is, well, actually, Japan's QE experiment had not pushed up M2 growth beyond 5% in the last 30 years. Today, it has gone to 10 and has come back down now. So even Japan itself doesn't fit the caricature of Japan that we have in mind. And so using it as a roadmap, we think is a terrible idea. I'll conclude very, very quickly. We have 5 points we think inflation is coming. The way monetary and fiscal policy have injected money into High Street today is very different from QE injections onto Wall Street after the great financial crisis. We think there's a way to go for yield curves to steepen. The current rally that we've seen in treasuries over the last 2 or 3 months we think is a short-run respite, which will soon be turned around. Number 3, good news for inequality is that asset returns will be harder to extract. The problem is that you will get more power for labor, but within the context of lower growth, it could have been better, but it hasn't been. And the last one on which Charles is clearly an authority, one of the key points that we make in the book is that this benign symbiotic period of the last 30 or 35 years in which central banks and finance ministers were great friends because inflation was falling and everyone was happy is probably coming to an end. Over time, if central banks try to assert control on inflation, they will very, very quickly run foul of what administrations want from them. And the political economy is likely to get very interesting from here. But I'll leave it there. I think we've run over time. Apologies for that. Thorsten, back to you.
Well, thank you very much, Manoj, Charles. This was quite a tour d'horizon over the current trends and what is ahead of us. And when I initially said it's good to look into the kind of long-term trends, I didn't say that these were good trends, right? So it's clearly, in your view, it's not good trends. They are rather risky or dangerous trends. And of course, it gives us lots of food for thought. So let me then now turn maybe first to our advisory council members and see whether any of you would like to come in, comment, ask a question. At the same time, participants, please ask your questions in the Q&A box and I will pick them up and pass them on to Charles and Manoj. So anybody from the advisory council would like to come in? Yes, Boshan.
Good afternoon, and thank you very much, Professor Guthard and Professor Pradhan, for this very interesting presentation. I've been following what you were saying for some time already, and then I'd just like to make 2 remarks and then maybe one question. I mean, I really like coming from the central banking community. I really like the way you enlighten us with, and then trying to help to demystify this, the only game in town the myth that was somehow popped out in recent years, literally blaming central banks for everything, while being the only cornerstone in how we were addressing the world. So for that, and in particularly for addressing the issues that cannot be addressed by monetary policy, namely demographic factors, lower productivity, rather constrained trade flows, and then this is all that the central banks have been trying to address, and then got into this trap of being accused of not succeeding in this respect. So I really like you're saying unless the fiscal policy does it right, which is for me this complement that is constantly missing in all the discussions, and then for that I'm extremely grateful and thankful for you to brought up the issue on all the other factors that do affect and create the world that today we are faced with this rather disinflationary region. So these are my two remarks, and then maybe even more than the remarks. Big thank you for the topic and really excellent presentation. But then my question is, wouldn't you consider the developments in Africa to resemble what was happening in China, and that would somehow mitigate the effect that you are now somehow pronouncing, expecting, because Africa is in a sense of a similar size of China, and this could be repeated, and then again mitigating everything what you've made a story around the effect of China. Thank you very much.
I can take a quick crack at that. Actually, we'll make your question twice as powerful, because Africa is almost exactly the same size as India. And if you put the two together, they also have very benign demography that's coming against us. The problem that we think is that while both of them are very likely to have a very benign path ahead, we have very high expectations for growth for both the sub-Saharan parts of sub-Saharan Africa, parts of Africa and India. Their ability to become another China is hampered by a few things. Number one, I think that rather than being in a globalized age as China was, and hence a very strong beneficiary of the outflow of capital and the willingness of companies and governments to expand their borders, economically speaking, we're in an age of deglobalization, where heavy investment abroad is neither seen as smart from a corporate point of view, nor seen as desirable from an administration's point of view. But intrinsically, there is a difficulty here. One way to solve the demography problem that we have is that you could take labor from Africa and India and ship it over to the advanced economies where there is a lack of labor, particularly maybe to look after the elderly. But politically, that's almost impossible today. I think we can rule that out. If you then think about taking capital, physical capital, and taking it to Africa and India and transforming it into goods and services, that's a path that will lead to fruitful growth. But the ability of these two theaters in the world to transform that capital into output is much lower than that of China. The reason being very simple. If you look at Africa, again, as I said, the population is almost identical to India, but there are 50 countries. To have a unique strategy, the way China bludgeoned that policy through into the economy, is very hard for a single economy to do, as India and Modi are finding out, let alone for 50 countries to coordinate strategies and go ahead from there. Second thing is the human capital and the transfer of technology, in a sense, is also lower. If you go back thousands of years, India and China were the two main economies in the world. And China has outstripped India over the last 40 or 50 years very handsomely. But Indian society was village communism. They had guilds. They didn't have national transfers of knowledge as China did. And so they do fall behind on that. Africa's human capital is a significant constraint. And in both countries, actually, administrative capital is the huge constraint. Their ability to effectively use the country as a whole to transform incoming capital into services and goods, that's where we think the problem lies.
Thank you.
Thank you very much, Manoj. Ignacio.
Thank you for the fascinating presentation, which I had already heard once. So part of my questions have already been answered. I remain with two puzzles in my mind. The first relates to the fact that anybody who remembers the big inflation of the 70s and the early 80s knows that there were big demand shocks there because of the US social programs and the Vietnam War and so on. And there was an adverse supply shock, the oil shock, but all that translated into inflation only as a result of a propagation mechanism coming from the labor market. The labor market was unionized, and therefore any price shock was perpetuated by the labor market, and there was this back and forth between wages and prices. Nothing of the sort exists today or is at the horizon. The labor world is disorganized everywhere. So one alternative, I take the point that there will be an increase in demand, and that may generate a shock in prices, but an alternative scenario that could materialize is that the price shock or the demand shock does not translate into an inflation process, but instead of a big increase in inequality. So the prices will increase, the wages will not catch up, and we'll have an ever increasing inequality. And so that there will be no inflation in that case, but a different outcome. We already see inequality increasing, but that could increase even more. And that's very worrisome if you think about it. It's a completely different scenario from what you described, at least in the short to medium term, because it takes time for the labor market to organize itself. And that is not seen. The other thing concerning the debt, I take the point that debt is increasing and will increase even more for demographic reasons. If there is a temporary increase in interest rate, I would in inflation, I mean, I doubt that given the structure of the financial market, the global financial market, I doubt that will bring about a decrease in debt, in the debt to GDP ratio, on the real value of debt, because the interest rates will also increase. And if interest rates increase, that will lead more to financial instability, not decrease in debt, will not readjust the debt, but there will be more financial instability and potentially more debt defaults as a result of the increasing interest rates. So there is a different scenario in which instead of having inflation coming, you would see more inequality and more financial instability and debt defaults. Now, have you considered this alternative?
The answer is essentially yes, and particularly your first point, Ignazio, is very well taken. When we initially wrote the book, again prior to COVID, the response that many people had was yes, but the labor bargaining power has been so crashed. As you say, trade unions are vastly reduced in their potency now. National Union of Mine Workers, which was a power in the land in the UK, no longer exists in the UK. The UAW in America, and in the old days, politicians used to sort of invite trade union leaders to tea for meetings, to beer and sandwiches. That no longer occurs. And so the argument was that, yes, we see your points about the demographic trends, but the power of the unions, the power of labor markets has been so trashed that it may take a very long time for the underlying trends in demography and globalization to take hold. And we accepted that argument, and we, when asked, well, when will the turning point come, when the pressures on the scarcity of labor become so extreme? And we would say, well, we don't know to within plus or minus 5 years. We think that the turnaround will be by 2030, but it could be earlier, and we don't really know because of the points that you were making. But we do feel that the pressures that COVID has introduced is going to lead, even with Labour being much less well organized than in the past. The effect of COVID and home working has been to make a lot of people reconsider their attitudes to work. A lot of those who are old, whose financial assets are now worth a lot more, will probably retire early rather than go back to in-person working in offices. In my country and in the USA, I don't know about in Italy yet, probably not, because you haven't reached the same stage of vaccination. It has become extremely difficult for employers in the hospitality area to find enough workers, and they're having to raise prices and wages and sort of signing on benefits quite sharply in order to get enough workers. I went to our local village pub the other evening, and the menu was tiny because they can't find more than one cook. And I know it is uncertain, and the point you were making a very good one. But the effect of COVID on the supply side could well be to bring about a acceleration in the effect of the oncoming scarcity of labor. The longer trends could be brought forward. Admittedly, nothing is certain, and the point you are making is a very good one, but we think that COVID could be bringing forward the turning point whereby the scarcity of labor starts to bite earlier than it otherwise could do. Now, you also said that interest rates are unlikely to increase because if they try to increase it at all sharply or fast, we will get a lot of financial instability, and the answer to that one is yes. So that I think that in the very short run, by which I mean the next year or two, that interest rates will not rise by anything like as much as the increase in inflation. So that in the very short run, again over the next year or two, real interest rates, particularly at the short end, are likely to go down. I think that the increase in the real rates is a much more medium and longer term effect. In the short run, I think that the likelihood is that, in sense, for partly the reasons you indicate, that real rates will actually, if anything, decline further from where they are at the moment.
I'll make one very quick point on the financial instability issue. I think it's absolutely critical. You're definitely on to something that we've talked about in the book as well. But I do want to say here that the markets will be fully cognizant of this story. If inflation does indeed take place, let's take a look at a scenario where there is inflation, and for financial stability reasons, interest rates simply cannot rise enough to compensate markets for inflation. Their willingness to finance different instruments will change dramatically. So in places where you have the split between inflation protected yields and therefore creating break-evens, the willingness to hold break-even inflation will be much higher. If you look at the US yield curve today, break-even inflation is higher than nominal bond yields entirely everywhere along the curve. Second thing is sectors in the equity market, which are far more inflation sensitive, will get higher costs of funding. So you will start seeing inflation creating a two-speed financing structure, which itself will be the face of instability. So just because we are able to compress interest rates, if it's possible, and not allow them to keep track of inflation does not mean we suppress overall volatility. I think we will only end up displacing it. It'll be a complete mess. There's no way we can get away from that. The only way it works is if you don't have any inflation at all. If we turn out to be wrong, we'll be all very happy because our retirement will look a lot better. But if inflation does materialize, I don't think there are any simple answers out of this at all.
What Manor said, I would like to emphasize. We very much hope that we are wrong. The nicest way that we could be wrong is if medicine came up with a cure for dementia, Parkinson's, and all of that, and the old are able and willing to go on working a great deal longer than they do at the moment.
Thank you very much, Charles. There are a couple of questions in the chat, but actually I would like to add a question from my side. It's more like a comment in the question. So there have been references to inequality within country. Maybe, I mean, in the UK and also in other countries, there's also more income inequality relating to age, right? The young versus the old. There was recently an interesting series in the Financial Times discussing exactly that. And that the young don't have the same chances as the older ones. And of course, this has also political implications. And you kind of see this discrepancy coming up again now, of course, in the UK, for example, with the prospective increase of 8% in the state pension due to the triple lock. We see it in other countries, in Germany, for example, with electoral promises for the older population. I mean, to which extent can this also lead to additional political problems? And then also this directly relates, of course, to your solutions. I mean, so we need some kind of taxation. It could be inflation taxation, it could be income taxation, it could be wealth inflation taxation. And it seems that in allocative terms for growth, the wealth taxation, which would then probably fall more on the older population, would be more efficient than income or inflation taxation, which would fall on the labor income and maybe depress growth even further. So that would actually then make the situation worse, kind of lead almost to like a vicious cycle. And again, coming back to this political dilemma that certain taxes cannot be increased.
I think that you're right, but one of the problems is that the old vote and the young tend not to. So a taxation which falls primarily on the old will again be very difficult to introduce politically. And economists tend to think about economic optimization. I think I was always rather sorry when we changed the title of our subject from political economy. I think that actually we need to think about political optimization under the present circumstance, because it's the politicians who actually put in the policies. And therefore they will optimize over their chances of re-election, and whether you could shift the balance of taxation onto wealth is, I think, a moot point.
Yeah. Thank you, Charles. Francesco.
Thank you very much for the absolutely fascinating presentation. I have one question. When you speak about inflation, what type of inflation are you referring to? It's a mildly higher inflation. It is a hyperinflation. Is a Turkish type of inflation where you have 2 digits, but the economy is still functioning. And the second question is perhaps has already been partially answered. Do you think that surprise inflation is possible in a highly financialized world where basically financial markets would adjust and would diminish the possibility to reduce debt via inflation? Thank you.
Well, let me take the second question first. Yes, of course, surprise inflation is possible. We have it at the moment. And how many people expected the US CPI to be 5.4% on an annual basis, and considerably higher than that on a 3-month basis, shall we say 6 months or a year ago? And what is happening at the moment is a absolutely patent example of what to most people was surprise inflation. It wasn't to us, but to the vast majority of people, this is an enormous surprise. And we believe it will go on being a surprise, because remember, everybody is saying it's going to be transitory and it'll fall back without anyone having to do anything, back to sort of 2%, back to target next year. And for the reasons Manoj said very clearly, we don't think it will. We think it will go on being a surprise. So surprise inflation, I think, is very much alive and well. I can't remember the first part of your query, so Manoj, if you could help me out with that.
It was about the type of inflation, whether it would be a mildly higher inflation, a hyperinflation.
I don't think, no, it won't be. I don't think it will be hyperinflation because there comes a point, and our argument is that inflation is part of what will become politically optimal. It's not politically optimal to have hyperinflation. It's a sign of complete and utter political failure. The question, I think, is at what point will inflation become so politically undesirable that it will be acceptable to undertake particularly the fiscal policy changes that are necessary to return to a sustainable overall equilibrium. But in terms of the longer term, and our view, I think, is that if we had known what was going to come in terms of globalization and population trends, we would have argued for a zero inflation target from 1990 to 2010. Given our view on the globalization and demographic trends turning into a tailwind, we think that it would be quite sensible to aim for an inflation target over the next 30 years of, shall we say, around 3.5% to 4%. And we think that once the costs of higher inflation and the expectation that it will persist unless something is done about it, come into become upfront among the politicians. We think that when it does become an accepted viewpoint, then we will actually have inflation at about 3 to 4% on average over the next 30 years.
Francesco, I'll make one small point. I think, in my experience, the one place where the power of markets, as you put it, is blunted very heavily is in a low vol environment where no one wants to have any confidence in any macro bets. Everything is going to be normal. No one can take any outsized positions. No one has the willingness to risk much capital on, what we call out of consensus bets. In a world which is inflationary and inflation surprises come along, I can tell you today, for example, that the best answers that I hear from my clients when I talk to them, and they include, all your usual suspects, is we just don't know. No one has any clue on how much is transitory, how much is a little bit more permanent. And I suspect these prints are at least making them think again. But if they had a situation in which they could exploit a changing trend, nothing would give them more power and more willingness to deploy large amounts of capital, take on significant leverage bets. You'd get huge winners and losers. There's no doubt about that. But there'd be financial institutions which would thrive on that, not really get hurt. I think obviously the ones who would get hurt would be the more traditional, slow moving ones. I'm thinking of massive pension funds where asset allocations change by 20 and 30 basis points a year. But fast-moving institutional money, I think, would be very happy to pursue that kind of situation. So you would see turmoil, but I'm not really sure they'd be able to keep down inflation.
Thank you very much, Charles. I want to pick up some questions from the chat, and I'm going to combine two of them. So one, of course, as you mentioned earlier, Charles Manoj, you wrote this book before the pandemic, and of course lots of things have happened, and you actually think that it reinforces some of the trends that you've been discussing. But one recent policy initiative has been this global agreement on minimum corporate taxation. Does it have any impact on your story? That's one question, and let me just add one right away. Actually, it's a question from Hideki Sato. To what extent do we need to reassess the effectiveness of the Fisher equation? What's your standpoint for the limit of relation between the money stock and price index based on a longer term perspective?
I think the global tax agreement is highly desirable, but I think we've got to go a lot further than that. In particular, I think that you've got to get rid of the fiscal advantages of debt and provide a fiscal level playing field between equity finance and debt finance. The advantages, particularly given the incentives of corporate managers to go in for high leverage, high debt finance under limited liability, I think is very strong and needs to be countered. So there is a lot that needs to be done on the fiscal front in many ways, but it's going to be very difficult politically to introduce any of them because there are always vested interests in the present system, and a change is always going to upset those who are particularly targeted. Those who suffer are always much more vocal than the majority who benefit. So I think that there's a desperate need for a lot of work on the fiscal front. I'm going to pass the question on the Fisher relationship over to Manoj, because I'm afraid I can't exactly remember which the Fisher relationship is.
Well, I'll make one small point on the earlier comment on the G20. I mean, it seemed to me that you wanted to leave corporations no place to hide, but that's not really matching the chart that Charles showed, which is the increase in debt that's coming. This is only saying that, look, we need more of a level playing field, but whether you can hike taxes enough on corporations to pay for a lot of that increase in debt that's coming, I think that's the part Charles was addressing. On the Fisher equation, I mean, look, there have been tumultuous periods, right? Our argument in the book was what China did very effectively was it solved the impossible trinity by keeping strict control of interest rates. And when it kept capital flows, and when it stopped capital flows at the gate, it was able to have monetary independence. And it effectively said you cannot participate in financial markets in China if you want to access the rate of return. You need to have physical investment here. And so the advanced world in which you had the US economy, for example, if physical capital was flowing into China, and therefore you created an excess of ex-ante savings over ex-ante investment, it's the US economy that sets global interest rates. And so as global interest rates came down, they were far easily able to outstrip the declining inflation. And so you had real interest rates coming down. Those were periods that were a real friction. I mean, I don't think anyone would think that the Fisher equation holds at all points in time across all horizons. And certainly when there are these massive global forces going. But over a period of time where I think you would expect to see some of that normalization. And unfortunately, we don't know what new problems will come up. There could easily be, what we'd call unknown unknowns that come up and disturb the real equilibrium again. But broadly over a period of time, you would expect some normalization of national inflation. And if that is true, then at least on a national basis, you'd expect to see a little bit more of the Phillips curve holding. I mean, all I have to do is take you back to that initial slide that I had pointed out, where I was saying that the Phillips curve equation in the US stopped working because China was disinflating the world. I mean, that's the best way to look at when a Fisher equation may not hold in the US, but it may be globally rational. So I wish I had a better answer to your question, but I think we'll just have to look at whether global disequilibrium over that last 30 years is ironing itself out, and then we can think of the Fisher equation working better.
Thank you very much, Manoj. So we are at 3:45 sharp now here in Florence, and 2:45 on your side. Thank you very much. This was quite insightful. Thank you very much for the great presentation. Thank you for all the discussions from our advisory council that came in, and also for the question from the Q&A. My apologies that we couldn't answer all of them. But I think you gave us quite some food for thought. And of course, the next, I guess, 8, you said 2030. So the next 9 years will show where we are headed. But yes, I take your point also that you would love to be wrong, but you are afraid that you're not wrong. So on this note, again, Charles, Manoj, thank you very much for joining us today, and have a good afternoon. Thank you.
Thank you.